Evening, Stonegate audience. I hope everyone is doing great tonight. Sorry I missed you last week. The reason I did, I had the distinct honor and privilege, the opportunity really. I spent another 4 days with Donna Bauer at her note buying academy there in Cincinnati, Ohio. Just another great experience, met some great people. Some newer note investors. I was able to share with them some information, was able to present a case study just about some of the experiences that we have had in note investing and such, and took a ride on a riverboat again. The skyline was beautiful, and just even more importantly though, really continued to reinforce a lot of the basics of note investing. So one of the things I was talking with people last week that partly gave me the idea for tonight's talk is just mathematics and its importance in note investing. And you can do things correctly even from a math perspective. It's not a guarantee that things will work out, but if the math is really going against you from the start, your odds of having a good, successful outcome with any note are really not too hot. So I just have a couple tonight, actually. When I really started putting this together, I thought it would get a little bit longer than what I wanted to spend with you tonight. So I made tonight part one. So this is some mathematics for note investors. Tonight is going to be more so actually a little more geared toward performing note investors and notes, and I'll tell you why in just a minute. These are just two really simple, basic equations that a lot of note investors will be familiar with, but a lot of newer people or that don't really know what all this mumbo jumbo is about, they might learn something. So one of the first things that we look at when we evaluate any note is called loan to value. And what that is, it just means it's a reflection, it's a ratio really, of the total value of all the loans divided by the value of that asset. So for example, if you have a $100,000 home, you and the seller agreed to a purchase price of $100,000, and you've been, active, you've saved all your money, you've managed to put away a 20% down payment. So you have 20% to put down on that house, $20,000. So with this particular example, then the math would be very, very simple, okay? You would just take your $80,000 mortgage, okay, and then you would divide it by the value of that $100,000, and it would be 80%. That's pretty good for a note, actually, okay? I've seen them actually go for higher, but 80% is about in the ballpark of where we want to be. Now, again, this is much more helpful when you're evaluating a performing note. I look at it a little bit when you're evaluating a non-performing note, but I care a lot less. Why? Because on a non-performing note, I already know that this borrower is not paying. So, they don't have a lot of incentive really to pay at that point. Another interesting note about the loan to value ratio, it's also called the LTV, that it can change over time. A lot of people don't always understand or really think of that either. So say I'm not looking at buying this note, right away, say 3 or 4 years have passed since this note was originated, and then someone contacts me about buying it. So the house probably isn't worth exactly $100,000 at that point. It could have actually gone up in value, okay? And then at the same time, the amount that they owe on the house, their mortgage, probably went down just a little, not a lot. That's the way mortgages work. Your first couple years are mostly go toward interest payments. But the value of that mortgage, the underlying unpaid balance, probably went down a little bit over time. So if I really had to guess, it would probably look something more like 78,000 divided by, say, like 110,000. Now, those numbers are right off the top of my head. They're not, purposely I didn't do all the math with everything, but it would probably even be less than 80% there, which would be good, okay? Because that is a measure of the borrower security. It's a measure of the borrower incentive to stay in that house. However, and this is maybe very important coming up soon, nobody knows for sure, if we were to have another recession or if housing prices were to drop again, okay, and say the value of that $100,000 home, say it wasn't $100,000 anymore. Say the value of the home dropped to, $95,000 or even $90,000, okay? That would drive up the loan to value, which would not be a good thing, actually, okay? So that would not be good. It can change either way is my point. And then the other short equation, just simple, another one that I don't know if I was the original one that came up with, but I don't see a lot of other people look at this. It's just plain and simple, the borrower equity. Instead of looking at it as just a ratio, which is good, it's helpful information, but it doesn't always tell you a lot. I like to just look at the amount of the house value minus the amount of all the loans that are on it. So again, the same example that I had here, I just use the same example to keep it simple. If you just take that $100,000 house and then you subtract the $80,000 that the borrowers owe on it, you come up with the borrower equity of $20,000. I don't know if you can see that at the bottom. As you can see, I started running out of space on my board, but I find that very helpful because that $20,000, say this borrower, for whatever reason, they just stopped paying, that's kind of what they stand to lose in foreclosure, okay? They could conceivably lose all $20,000 of that. So that gives them incentive to just stay in the house and continue to pay on that mortgage. Now, what I do have in the bottom here in capital letters, both of these can look great, but again, it is no guarantee. But if they have a fairly low loan to value ratio and they have a good amount of equity in the house, again, they have an increased incentive. They have just money that really gives them, it's almost like a bonus for them staying in the house. So that would do it for tonight. I see we have a couple people that joined us live. That's always great. I love to see people that join us live. Did anyone have any questions here? Let's see here. No questions, but thank you very much, everyone that joined us live. If you're watching a replay of this and you do think of any questions, by all means, feel free to write it in the comments. I do check that out from time to time. And I'll put my email address in there if anyone is not on my email list and wanted to be added to that. Until next time then, that is how you climb the hill. Thank you very much, everyone, for tuning in tonight, and until next time. Bye-bye.